Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Comcast stock. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you would like me to analyze, just put it down in the comment section. I will get it on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500, I post those here on YouTube for free. And if it's not, I post the rest on Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. If you do join Patreon, you can get a big discount to the full service if you ever decide to join there, where I have a lot of other services, including the spreadsheets that you see, chat rooms, dozens of articles that aren't available to the public, and all sorts of other great stuff. Those links will be down in the description. As always, this isn't individual investing advice. This is just how I analyze stocks. All right, let's get into Comcast here. I've covered Comcast before, so I want to start with that because whenever I've written on it, but I've actually made videos when I first launched the YouTube channel for about 3 months. I made videos in 2021. Comcast was one of them. I am long Comcast. I've been long Comcast since March 20, I think it was actually the last day in February of 2020, right when the pandemic started. It was one of the first stocks that I bought, and I'm still holding it. I think other than Berkshire, it might be my longest holding at this point that I still own. So I'm obviously I don't think it's a sell, or else I would have actually sold it. But going back to when I made this video, it was, I think, mid-February 2021, almost 3 years ago. And it was a combination article of Disney and Comcast. So what I was doing, making the case that owners of Disney stocks should take profits and buy Comcast instead because it was a better alternative than Disney, even though they had some similarities with their businesses. And I actually did a ton of research on Disney before this article. I'll put a link down in the description to this video as well, so you don't have to go searching for it since it's so long ago. Definitely worth watching for if you consider buying Disney or Comcast, especially Disney, which is on the board, and I'm going to recover it again soon. But you definitely want to give this one a watch. It's not like my normal videos. This is one where I do go a lot more in depth into the actual businesses than I am going to do in this video or other videos where I mostly focus on valuation and numbers with a little bit of my commentary on the business. But you can see that my thesis was very simple: sell Disney, buy Comcast instead. So here's how they've done since then. Disney stock is down 52%. Comcast stock is down as well, about 12%, so not nearly as bad. They both underperformed the S&P 500 equal weight, which is up 20% since then. But you can see the divergence once the market bottomed, that Comcast has come back much stronger while Disney has languished down in the doldrums since then. So that's kind of where we are. I think my call was correct, but we haven't seen the actual just raw performance of Comcast other than like the mega cap tech, which is what's held up the equal weight. There wasn't a whole lot to buy in 2021 that was decently valued. So I think in terms of that, Comcast I feel okay about buying it at that time. I think my personal position is actually positive now because I bought it in 2020 instead of 2021. But it hasn't done too badly compared to Disney. I mean, you definitely would have done better. So let's look at Comcast today, and then in a future video coming soon here, I'll look at Disney as well. We're going to take them separately this time. So when we look at Comcast earnings history, we see a pretty steady increase in earnings per share over time. The one exception is COVID. These guys are mostly like a cable business, so that's their business that is slowing, maybe even shrink. I haven't looked closely at the recent earnings reports, but maybe even shrinking at this point. But it's definitely stagnating and struggling because of cord cutting. On the flip side of that, they also have theme parks. They also make content. They have movies, and they have Peacock, the streaming service. They also are partial owners in Hulu, and I believe they're probably going to sell that to Disney, so they should get some cash from that. I'm not sure if that's gone through or not yet, but overall, other than the COVID decline, which is understandable, they have grown earnings very well over time. Not very cyclical overall, although they might become a little more cyclical if cable becomes less of the core part of their business. One thing definitely worth pointing out, they do carry substantial debt, which is not unusual for a type of business that needs a lot of infrastructure and investment. But when I do the valuation, I actually add about 50% to the cost of the stock. So to think about it, an 11 PE would really be more like a 16 PE or something like that. Once the debt is taken into account, if you were going to buy the whole business. Let's see. So that's, I think, the setup of everything. Now we want to basically see what earnings growth did, because we want to try to estimate. It's going to be difficult to forecast too much because we don't know what's going on. But what I would say is the transition out of kind of normal cable service is going to probably be slower than people expected. I mean, I cut the cord in 2009, so I was one of the first people, because I don't really care about television. Now I watch more because we have like every streaming service, I think. But back in the day, I mean, I didn't really have a need for it. But they do have high-speed internet and things like that too. So I think the main thing to remember is this is probably going to be a slow transition. I don't expect, whether it succeeds or fails, I don't expect a crash. As long as a person buys the stock at a decent price, they're probably going to have time to make adjustments over time. No matter how it turns out. So let's look at the earnings growth. Earnings growth on fast graphs is 11%. I adjust for downturns, even COVID, and I also adjust for any buybacks. I don't remember if they had substantial buybacks, but I do try to account for that in my earnings growth estimate. So mine is 9%, a little bit more conservative than the previous historical earnings growth rate from here to here, but actually more in line with what analysts expect over the next 3 years. I don't use this to actually make my earnings growth estimates. Well, sometimes I do with some stocks, but typically I don't. I use history, and I assume history is going to kind of carry out. But we know kind of the background of everything. So I'm pretty much in line with what analysts are expecting going forward in terms of earnings growth. So the other major thing is we want to adjust for that debt, which the way I do it when I'm calculating everything to make everything easy is I look at how much higher that total enterprise value is compared to the market cap. Whatever percentage that higher is, I adjust the stock price up by that percent. So in this case, it's about almost 60% higher. So I treat this as though the stock is actually trading at a higher price when I create the PE ratio and earnings yield. So I treat it as it's trading at $68. So this makes it look not as cheap as a person who just looked at the straight up PE ratio might do. So when I do this, I get an earnings yield of 5.73%. Okay. Earnings yield is the inverse of the PE ratio, so it's the same thing as the PE ratio. It's just expressed in a percentage of earnings. So the way to think about it is, if you bought Comcast for $100, including its debt, you would earn $5.73 a year on your $100 investment. That would grow at 9%, 9.1% is what I assume. What I want to know is how much money as a business owner could I collect over the course of 10 years with those assumptions. I get to $195 on my 100, so really 95 in profit. So if you're doing a CAGR calculation, it would be $100 is your starting amount, $195 is your ending amount after 10 years. You do that, you plug that into a CAGR calculator, and then what you get is about 7%, I think. 6.93%, okay? So the average stock in the S&P 500, I have it, we'll call it 5.5%. So, and then 8%, above 8% is where I would consider buying with some margin of safety. 6.5% is kind of the middle point of there. That's about fair value. So this looks pretty cheap, very cheap relative to the market. In the top 50 for sure in terms of value of stocks that I track. So that would put it in the top like 10% in terms of relative value. But not a lot of margin of safety at this price. Probably would have had to buy it earlier last year or something. So it kind of depends. If you're a money manager that can't hold cash, a stock like this looks pretty attractive. They also might pay down their debt if they sell Hulu, so that would increase this valuation. I haven't done the math on any of that. I don't know exactly how it's going to work out, but somebody who really dug into the numbers and was doing like a deep dive could try to do that. They might even be able to make it work, and it might work out to a much better deal, or at least buyable at this price. But for me, I like to keep it simple and then get a margin of safety. So I would be waiting for that 8% threshold, which means the price would need to come down or earnings go up more than expected. So when we do that, this actually produces a $35 buy price, which is only less than 20% lower than here. So it wouldn't have to fall very much under normal conditions. And then if we want to include like a recession calculation in there, which I'm not going to go into the super details, I do it in like every other video, then it would be a little bit lower at 32.96, like about 25% lower. So 20 to 25% lower, that would be your margin of safety. There is a little bit now, and I think it's a person could start layering in here and keep adding. I usually just take like one position at a time, like one chunk, because it's easier for me to measure my results. But a normal person could just layer into this if they wanted to at 7% CAGR, and layer down. And then if it goes deeper, add a little bit more. But you want to set that up ahead of time and have a plan of attack there. So in terms of that $33 buy price, yeah, I mean, it was there in October. It was below there in October of 2022, not October of this year. Even sooner, really. Well, not quite there. But yeah, so we saw it. We saw that buying opportunity here. Could very well come back. Just depends on what the market decides to do. So I would keep an eye on this. I take 1% weighted positions, so not like giant positions. Going up to 2% is totally fine. Some people don't monitor as many stocks as I do, so they have fewer opportunities basically. If you're one of those folks, or you like to make sure you do the deep work ahead of time, higher weightings are fine. But just going off what I'm doing, using my methods, 1% or 2%. If a person was going 2%, I would be like a layering in type of thing. I would think. So that's my take on Comcast. I'm still holding it. I think it's a decent holding. I think they have the best management. I mean, they squeeze everybody. Probably I don't have a Comcast. I have like a local fiber provider, but for my internet, and I still don't have cable. But everybody hates their cable provider, but they squeeze every last dollar out of people. And so on a customer endpoint, it can be annoying, but and it just goes for everything that they do, whether it's Peacock, they're doing it with the parks. The management is so much better, especially back in 2021 with all the streaming stuff and Disney. There's not even a contest between Bob Iger and the people at Comcast. I mean, they're heads and tails better than him. So really, you just kind of have to trust they're going to make the best of it. As a shareholder, very shareholder friendly as far as I'm concerned. So I'm happy holding it, unless I, find something, unless I run out of cash and find something that looks a lot more attractive. I'll probably be holding it for the foreseeable future unless we see revenues really fall off. Revenues are okay. So this is 3-year cumulative, so like 5% a year over the last 3 years. Not great, but I mean, this is a big established business going through a transition. So given all that, it's not bad. I mean, I've definitely seen worse. So yeah, that's my take. If you found this useful, hit the subscribe button, hit the like button, and if you have a request, just drop it down in the comment section. I'll reply back when I put it on the board behind me. See everybody later. Bye.